I'm Sean Delaney, and today on the What Got You There podcast, I sit down with Chris Mayer, who's the co-founder and portfolio manager of Woodlock House Family Capital. Now, Chris is an investor, but we dive so much into what he's learned over all the years studying great businesses, great entrepreneurs, and making critical investment decisions. So if you want to understand more about how to see the world clearly, how to understand your own biases, and then how to improve over time, I think you'll love this conversation with Chris Mayer. What Got You There is a podcast for high achievers looking to learn from the most successful people of all time, what their strategies, lessons, and routines are that made them successful. Now it's your journey, so it's time to learn what's going to get you there. Chris, welcome to What Got You There. How are you doing today?
Hey, Sean, I'm doing well. How about you?
I am doing really well. I thought a fun place to start this conversation would actually be a line that you posted on Twitter the other day from a book you were reading. And it's "A life spent chasing dreams is a life well spent. Anyone who does this will get to the end of his days and look back with a smile. He will have had a ball." So this is from the legendary Bob Rotella, who's worked with tons of different golfers, plenty of different people in sports. And I would just love to know what this line did for you. Like why did you feel compelled to post that?
Yeah. I've been reading Bob Rotella for a while. I think I have all his books and they're all kind of the same, but it's still great to read them. I mean, every time he just keeps enforcing these basic things, which, by the way, go well beyond golf, which is another reason why I think I like him. But yeah, in this particular case, I think, and this relates to investing too. With golf, you're never going to achieve any level of perfection. You're always going to be wanting to do better. I remember long ago when I was first learning to play, I'd say, boy, being able to break 100 consistently would be great. And I did that. And then it's like, gee, it'd be great if I could get in the 80s consistently. I do that now. I'm like, boy, it'd be great to have a single digit handicap. I'm like hovering at 10 and you're still never happy. You're always pushing. And investing's that way too. There's never been a year where I didn't think, wow, I could have done better. There's always room for improvement. So instead of getting discouraged about never being able to achieve those dreams of perfection, you just sort of use those as your ideal and realize that that's the fun. The fun is in chasing it. And when you look back on it, you'll be satisfied that you gave it a good go, and the result will be satisfying, even though it doesn't reach that state of what you dreamed might be possible.
Yeah.
So I think that's important, especially for investors too, because there's long periods of frustration, boredom, and times when you're not doing well. and just to keep that dream in mind and chase it, that's I think a good way to be.
Well, this has me wondering then, you mentioned trying to break 100 consistently, 90, 80. Are there benchmarks like that you equate to investing that you try to follow or get underneath?
Yeah, I think with investing, you have to be careful. And Rotella talks about this in golf too, that you can't be totally focused on outcomes. So yeah, I used the scores there, which maybe wouldn't have been the best thing to use, because in books, he also often talks about process, running through the same process, whether you did everything you wanted to do in that shot mentally, not regardless of how it came out. So obviously investing is similar. There's a process that you want to be able to follow, and you can't really control the result. Stuff happens all the time, of course, that we have no control over. But yeah, I would say over time, you get more comfortable with your process, you refine it more, and it even gets simpler over time if you do it well. And there's certain things that you're really looking for. So that's fun to see. And so really, when I evaluate investment, looking back on it, it's not always just, well, did it deliver the highest return? But it's, did I follow my process? Did it really fit? What kind of work did I do on it beforehand? And you kind of evaluate that process.
Yeah. I'd be intrigued to hear you go further on the simplification process. Like, what does that look like for you right now as you try to simplify more?
Yeah, I think it took me a long time to learn this, because I remember being distracted with all kinds of things that don't really matter over the long term, whether a stock works or not, whether it delivers really good returns or not. I mean, I remember a younger investor, I always would get hung up on things like PE ratios and, the multiple today. And, you get overly concerned about macro, and particularly near-term macro, what the next few quarters are going to be like. And now, I ignore a lot of that stuff, or I have a better context for it than I did before. So I think simplifying it means for me getting it down to the real essentials. I used to love, I still do. I haven't read it in a little while, but I loved Marty Sosnoff's early books. One is called Humble on Wall Street, and the other was called Silent Investor, Silent Loser. And he's a very different investor than me. So if you go into those books thinking you're going to learn some secret, you're not. It's more of a well-written memoir, but there's one thing he keeps hammering home, which I really like, was he always says that investing is a minimalist art. So it's something where you get down to the essentials, and he has a number of other examples. The Sosnoff's law, what he calls, is how your return varies inversely with the thickness of the research file. So it's like the more work you do, more complicated things get, more justification you have to do, more likely that investment's probably not going to work out. And that's echoed in some of the other great investors. Chuck Ockray stands out for me. He's someone I've learned a lot from. And he always says, rate of return is the bottom line of all investing. It's a very, very simple concept, but he's just looking at rate of return on the rate of return capital of those businesses and their ability to reinvest, and everything else is sort of noise, or everything. You really just want to get to the essentials of what feeds into that point. So that's really what I think over time. When I talk about things getting simpler, that's what I mean. Getting more honed in on that kind of return of the underlying business, their rate of reinvestment, and then you back into that. You have to think about things like competitive advantage, the durability of them being able to continue to generate those returns. And you start thinking much further out. So, you start thinking in terms of next decade, and you see what kind of number that can get you. Then you're much less concerned about even a 30% drawdown in the near term. Doesn't really mean much in the context of a 10-year journey.
You mentioned that extra information isn't always helpful. There's that Grace horse racing or horse betting research where they basically had about 20 data points they could go off of, and they measure that in correlation with their ability to place the bet and then also their confidence level. But then what they ended up finding when they gave them additional pieces of data, so they went up to, I think, 40 pieces of data. Not only did their betting actually go down in terms of the positive results, but their confidence level went up. So more data, more confidence, but actually worse results. That's one of my favorite examples of that.
I've seen similar things like that. In fact, I put an example of that in my book, How Do You Know? I think it was a slightly different example. It had to do with selecting cars and whether they had 4 pieces of information versus like a dozen. And you can see that, their choices, they didn't get any better. Let's put it that way. In some cases, it got worse with more information.
Speaking of things you write, you recently had a great article I loved, Make Haste Slowly, essentially talking about some of these things, this longer term way of thinking. But what intrigued me about this is, in a culture where we're constantly being bombarded and being nudged to take action, right? How did you develop that patience over time?
Yeah, I mean, it takes a lot of time. I remember making a lot of mistakes early because I listened too much to the buzz of what was going on. I mean, some of it is the more you study about the great businesses. And some of this was like when I wrote 100 Baggers, that came out in 2015. So I did the research in 2014, and that was that was eye-opening for me too, because you realize, these great businesses just continue to compound even through all these kinds of macro concerns and things that people are worried about. So some of it is, getting a data bank of all these experiences in the past that will help you. And the other is you really pay attention to where you put your attention. There's a line I like, I forget who said it, but you are what you pay attention to. So if you spend most of your time on Twitter or any of the social media sites and trying to process and read what the latest news is, that's, you have to limit your feed on that. Some amount of it is probably okay because you just want to be aware of things that are going on, but you really need to put your focus on other things. And you can't, there's so much economic stuff that gets put out, the forecasting, the big picture predictions, and you really just have to tune that out. I know it's hard for people to do. I know even people I think are pretty good, sophisticated investors still, want to share the latest economic forecast from somebody that they like. And they just have to realize that I don't care how much you like that person, their analysis, you have to tune that out if you're going to be a long-term investor and really focus on owning businesses for a decade. Because if you're going to start making decisions that way, then when they change their opinion, then you're going to have to change yours. And for a lot of these businesses, their investable horizons go way beyond investment cycles and whatever people are focusing on today.
Yeah, it sounds like a lot of experience to be able to talk to those points. I want to dive back in a second here around what you pay attention to, but I want to dive back into that kind of that pattern recognition. You called it your data bank that you built up over years. I'm always intrigued about people and how quickly they can accelerate their own process. Do you think that that data bank, let's call it that pattern recognition, is something you really could have honed in and developed sooner? Or is it you just have to live a certain amount of life and just see a certain number of things before that'll really set in?
No, I think you could have learned it sooner. If you had the right teachers. For me, I remember early on, I experimented with all kinds of things. I mean, I remember reading even technical analysis books, early on, different charting books, and of course, reading Soros's book and the macro stuff. And even though I started with Graham and Buffett, that's what got me interested in investing. Natural curiosity made me explore all kinds of things, special situations, all kinds of stuff. So, for me, I kind of had to go through it. Maybe it's my personality type, but I think someone who's maybe smarter, a little more focused, maybe a little luckier in their early teachers could get that data bank much more quickly.
One of the things you do a really good job in, and this is one of the reasons I wanted to have you on, is you understand different domains and the impact, like golf, how you can pull principles from that apply to investing to your specific domain. And I'm wondering, are there other things you've learned outside of investing specifically, outside of studying someone like a Buffett or a Graham, that has had a really profound impact on how you actually invest?
Yeah, I would say, right behind me, I have these all the philosophy books behind me. That's why I think of generally, I've learned a lot just from studying some great thinkers of the past. I don't know in particular. Alfred Korzybski and his general semantics has been a big impact. I wrote my book, How Do You Know, is really about that. I would describe it kind of as a method of critical thinking. So that's been a big help. There's other guys I've taken inspiration from like say Buckminster Fuller is one of my favorite characters at history. I've learned a lot from him. So I would say yes. In fact, most of the reading I do now is not investing related at all. It's rare that I would pick up an investment book these days. But at the beginning, it was flipped. I mean, all through my 20s, I just devoured every investment book I could get my hands on. And in another room, I have an investment library that has a lot of those books. So I think you probably have to do that in the beginning. Just read a lot of financial stuff, different investors, different styles, learn about different periods of time, bull markets, bear markets, and the experiences thereof. But then, I think there's a point where you're probably filled up enough on that, and then you can start to branch out. I mean, I also used to read a lot of business books. Sam Walton's book, It Was Made in America, is one of my favorites. Remember a good book on McDonald's. There's a variety of those books I read, but again, I wouldn't read very many of those today. It's just natural evolution, or at least my evolution. Now I'm more spending time reading more classics. Like I just finished reading William James' Varieties of Religious Experience, which is a classic I've long heard of but never read. And
what did you take away from that? Because James is someone I've put enough different.
I love William James.
Yeah.
I love the way he frames everything in such pragmatic terms, always thinking about ideas in context of what fruits they yield. So he applies that to religion in that book. But his essay, Pragmatism, actually, a series of lectures that make up that book, I would recommend every investor read that. He has a phrase I always like: what's kind of the cash value of an idea? At the end of the day, what is something really worth? What's the practical value of it? And so he's an interesting thinker, and he's a very good writer too. So you can read those books and not get bogged down. Some of these classics are, of course, very difficult reads, but William James is easy to read.
Yeah. Well, one of the things that you noted, I think is just important to highlight is you're not just saying skip over those investing classics if you're starting out, where I feel like too many people will hear, oh, well, Chris just focuses on all these philosophy books. He doesn't even understand the basics, but it's that ascension up to mastery, where first you master the fundamentals, the principles, you were able to embody those, and then you can move on and start to pull principles from different perspectives. Do I have that correct?
Yeah, that's exactly right. That's exactly right. And I think it's good to do that too, because you see there's a lot of paths up the mountain. I mean,
Yeah.
certain people have different tastes and they'll go in different directions. And but it's good to have all those different models in your head of people who have done it different ways, right? I mean, Peter Lynch, very successful. He's one of my favorites early on. I still have the hardcovers of 1989. I always get mixed up which one came out first, Beating the Street or One Up on Wall Street. But there was like 89 and then 92 or 3. I still have both of those books, but his style is different than mine. He owned a lot of securities. I own 9 today. He owned, who knows, hundreds. So, but it's good to have those backgrounds, different ways to succeed.
Yeah, talking about multiple ways to go up that mountain. I'm actually really intrigued about the way you went up the mountain. I mean, you had a somewhat interesting journey here that gave you a lot of different experiences, a lot of opportunities to see the world, learn from different people. I would love if you just kind of give a broad overview in terms of your journey early on, and I would love to dive into some specifics here.
Yeah, I definitely had an unconventional journey here. Right out of college, I mean, studied finance in college, but right out of college, I started in commercial banking. So I was on the debt side there for 10 years. And that was actually a good place to start, because you do learn a lot about different businesses and, the way banks underwrite businesses. It's much more detailed than a typical equity investor. So they're thinking about, we used to do on-site audits. We spent quite a bit of time with management. We spent quite a bit of time trying to evaluate what a business might be worth in a sale, and testing the different stress levels of it, because of course our upside is capped. So we had to make sure we get our money back. And it happened in those times too. I was particularly influenced by Marty Whitman, who was, I think, also started as a credit analyst. So it was good training, because it makes you focus more on downside protection. I was always interested in investing, so I started a newsletter just kind of on the side as a kind of nights and weekends hobby project. And then eventually I sent it to everyone I could think of. And eventually I got a deal with a publisher in Baltimore, and I just jumped and did the newsletter full time, left the bank.
Can you describe that process? I feel like it's a really interesting inflection point. This was with Agora Financial, right?
Yeah. So I just had a newsletter. I remember I would print out copies, and my wife and I would stuff envelopes and send them out. Yeah. I mean, the web it wasn't anything like it was now. I mean, I spent like $300 maybe putting together a website, very basic website. But it wasn't, I tried to market it as well as I could, but I didn't have nearly the outlets you have now. Now it's much better. But yeah, then I used to read. They used to put out something called the Daily Reckoning. Bill Bonner wrote it. It was very well written, and I corresponded with him, and that's how. And I sent him my newsletter. He goes, "Hey, maybe you'd be interested in writing this newsletter, for us." And so I spoke then with Addison Wiggin, who was running Gordon Financial at the time, and we hit it off. And so that's how I made that jump. And that was great, because then when I was running my newsletter, I traveled all over the world, met all kinds of businesses. I mean, even some places that are pretty far out, like Mongolia and Myanmar, when it was just opening up. Really get it.
Why were you traveling? Because I know you went to 40 plus countries. Why specifically were you traveling to all these places at the time?
Yeah, it was kind of a natural curiosity about it all. And I also had this idea of finding kind of out of the way investment ideas for people. Kind of like Jim Rogers or so that was fun. And since I was writing a newsletter, it came out every month. Plus there were like weekly updates. So it was a lot of content. It was easy to write it when I was traveling, and they paid my way, so I was getting paid to see the world and get a good education. I've been to China multiple times, been to India multiple times, all through Europe, all through Asia, all through South America.
What place left you most in awe?
Well, I would say there are a few places, but the first one just popped into my mind is Peru, because I hiked the trail to Machu Picchu starting in Cusco. It was over 6 or 7 days. And we had 2 guides, and we stayed at these little places along the way. That was really fantastic. That and Machu Picchu itself left me in awe. But in Cambodia as well, Angkor Wat was amazing. Now these are more tourist places, but still, I mean, I remember the first time I went to China blew me away. That was 2005. The first time seeing Shanghai was just incredible. The growth and this, it's just a hopping, booming place. Even I remember Dubai was another place that when I first went there, it was booming. That was just an incredible place to be. And then funny because then I went back to there when it was in bus phase. It was completely different. I remember arriving at my hotel and they knew my name already because there were so few people coming. It's like, wow. So yeah, it's definitely fun doing those adventures.
Yeah, this might be a tough one to answer and just kind of right off the cuff here, but mentioning just about learning so much, traveling all over the world, seeing all these different things. I'm thinking about the principle you were hitting on earlier around simplifying. You were kind of just simplifying down what you learn by seeing the world and experiencing all those different things. Is there anything that really has stuck with you all these years later?
Well, a couple of things. One, I would say is that it's much, much harder to invest outside of your home market. I haven't gone back and done an accurate accounting of it, but I would say my track record on investing in those far off places is probably not good. So I learned a lot that not to do. Things are just more difficult than they seem. And the other thing that sticks to me is how these stories recur. The boom around a certain place, and you can see that story repeat in other places and other times. And it rarely works out quite that way. So yeah, I think the overall lesson I've learned from all that traveling is just that it's very difficult to be successful in these other markets where you're not as familiar with them.
Takes a lot of humility there, a lot of self-awareness. I know this is something you've been posted recently. The first thing is you have to know yourself. And just the importance of that. And I'm wondering for you, like, what has been really helpful in your path, in your own journey to just more self-knowledge, this better understanding of yourself, how you best operate, and what games it makes sense for you to play?
Yeah, I mean, some of it is contrasting with other people. I have a pretty good correspondence either by email or talking to people, different investors, and so you can see how other people do it, and you can see what makes you comfortable or not. So there's just certain things I have kind of gravitated towards, also my own experiences. So I'm very reluctant to invest in, say, mining, and other people are much more comfortable with it. I've had different experiences. I've had some big giant winners in mining and some horrific losers, but I've just kind of decided that's more of a crapshoot for me. Or like retail, I haven't been a very good retail investor. And then there's other broadly more themes that I would say that I stick to. Like I've always been big on the insider ownership and alignment. And sometimes this is definitely a negative because there are great businesses where insiders don't own a lot of stock, and but they've done great. So I've missed those. But on the other hand, I think it's also kept me out of trouble. So, you kind of pick your own way, and there's not like necessarily a right or wrong. It's a lot of personal preference and what your own personal experiences have led you to think is important.
Yeah, life is absolutely great. There's no black and whites here, but I am wondering for you, analyzing some of the mistakes you made, missed opportunities, the ones that still stick with you, is it more errors of omission, bets you didn't place, or errors of commission, investments you made that just didn't pan out?
Yeah, I mean, I think it might be a cliche at this point to say errors of omission. Everybody likes to say that, but it's probably true. I mean, you look at stocks that you spent time looking at and never bought. Those are the ones that, why did I never own Apple? Why did I never own a Microsoft? Why did I never own Costco? There's just some great businesses that you just missed. So those hurt, but I mean, the ones that you invested in that blew up are also ones you always remember. I remember early on, I invested in a company called Lowen Group. It was a cemeteries and things, funeral homes. And seemed like, business you couldn't lose.
Yeah, I thought I thought that was the business you could lose.
Right.
What's going on here?
Right. That's what I thought. And then, well, they were too levered, and then there was some accounting issues, and so basically it went bankrupt. So that was one I always remember, because I remember thinking, well, this industry you can't lose. And I was too trusting in their numbers, too easy about risks, about leverage, and that stung, because at the time it was a lot of money for me. I basically lost it all. So sometimes getting those early lessons like that are great too. I remember thinking, even at the time, it was cost of tuition, and I wouldn't make that mistake again.
Can you actually go further in that? I'm so curious. After you said lose it all, and then you said that this is actually cost of tuition. What is your mindset like those first few days, weeks, and months after that, when you're facing reality?
Yeah, I mean, well, first you almost feel like kind of sick that you lost that much money.
You're gonna throw up right there.
Start sweating and like, oh my God, I worked hard for that after-tax dollars, and I just blew it, and doing something dumb. So yeah, first there's probably first stage is some pain, and then you kind of hope that somehow it comes back. But then when you realize it's done, you just start going back through it and figuring out, well, what was the big mistakes, and trying to make sure you don't do that again.
This has me interested, like just being able to bounce back like that, like that isn't true of everyone, right? Like that's a unique skill set. And then also one of the things you've mentioned again and again is just your innate curiosity. You've pursued that again and again. You mentioned that multiple times on your own path. I'm wondering, are there any other of these mindsets or attributes with you being able to analyze all the years, saying, you know what, this is probably somewhat unique to me, but this has been really beneficial for my own growth?
Well, one thing I say, especially when it comes to analyzing mistakes, is then you want to learn from them, but then you want to forget them. I know that's kind of counterintuitive, but Rotella, we mentioned him earlier. He talks about this too.
Feeling he might come up here. Yeah.
Yeah. It comes up in terms of golf, right? When you hit a bad shot, the best thing to do is you forget it. Because you're going on the next shot, you don't want to be thinking about, you don't want to be frustrated that you just hit a bad shot. You just want to focus on present, that point forward. And I think it's similar with investing. You want to figure out what went wrong, but then once you do, you just forget it, and you go on. So I think the ability to forget is important.
Speaking of things forgetting, I'm intrigued about things you'd want to remember. There was going to be a business throughout all of history that if you could do one case study on, because you hand this to enough people and say, you know what, this is what you want to study. There's a lot of gold in here. What business would that be?
Well, I think kind of the easy lame answer would be to say Berkshire Hathaway. I mean, and people have studied it to death. So, but I mean, there's endless amounts of wisdom in Buffett and Munger's, particularly the annual meetings. They're on YouTube now, and people put out little clips of 3 to 5 minutes long where they answer a particular question. Those are like candy. Those are great. Those are as good as Buffett's letters, maybe better.
Well, so now I'm really intrigued. Say you were starting out now, right? A completely different set of what you can pay attention to, what you can pull for your own self-directed learning here. If you were just starting out, what would be the top resources that you would pull from to build your foundation of knowledge?
Yeah, I mean, I would definitely, I think those YouTube Berkshire meetings are great. I'd still go with Berkshire. I'd still go with Buffett's letters. That was an early start for me. I still think that's a great place to start for people. They probably have more great letters to draw from. I mean, you can read, you can read Mark Leonard Constellation. You can read his letters. You could read, I don't know, Jeff Bezos' early letter in Amazon's a classic. There's a number of different letters that you could pull, but you'd have to have someone teach that or show that to you. So if you were just starting out, you'd have to be pretty lucky to just fumble along those. But I would say, you follow success. People like to say now, because everybody's read Taleb and everybody likes to say, oh, survivorship bias anytime you want to say study success. But I mean, that's the way to do it. I mean, same thing. If we've talked about golf, we might as well keep with the metaphor, right? But if you're going to learn how to play golf, you study Tiger Woods and the great pros. You don't go study the 20 handicapper you play with on weekends. So even though you won't reach, you don't have the talent or ability to be a Tiger or a Rory or any of those guys. Those are still the ones you learn from the best. I think the same with these companies. You learn from the ones that have been most successful over the last 20 years. I'm always fascinated when I come across a company that has been very successful doing something seemingly ordinary. So like an Old Dominion Freight Lines, it's a trucking company, but look at what it's done over the last 20 years. It's astounding. I mean, it's amazing. So I'm always interested in reverse engineering something like that. One that I've spent a little time doing recently, I don't own it, is Watsco. Again, the HVAC distribution. What is that business so special? What makes it really work? It's compounded something like 19% for 30 years. Why? How is that possible? So I'm fascinated in those kinds of things. Yeah, that's what I like to do.
You mentioned some of these companies like Berkshire, like Watsco. What are some of the commonalities that you've teased out? That don't often get brought up, right? There's a handful everyone always talks about. Is there anything else you're seeing that just doesn't seem to get as much play?
Well, one of the ones I like is that they have some sort of family ownership, or the founder is still involved. So you look at something like, Copart is another one I own. I mean, Willis Johnson was the founder, was involved in it for a long, long time. And then Jay Adair, his son-in-law, has been involved in the business since he was a teenager, and he also owns a lot of stock. So there's this culture. Even with Old Dominion, it's a family. The Congdons have been running it for a long, long time. Only recently, the CEO now is the first non-Congdon to run it. Brown and Brown was reported earnings this morning, is what I was on their call before I got on with you. Powell Brown is third generation Brown running it. They own a bunch of families, still has a bunch of stock. So there's a culture, there's a long-term mindset, and there's empirical research that backs this as well, the performance of family-owned firms. And mostly that comes down to, at least from what we can tell, is that they operate with lower levels of leverage. Typically, they have that longer-term mindset, so they invest counter-cyclically. When other people are pulling back, they are putting capital to work. And I think there's also something with incentives I haven't quite completely honed in on, but a lot of times these companies have some kind of good incentive plan, or there's something about the incentives. Constellation Software, for example, has their executives have to buy stock on the open market, and they're paid on combination of return on capital and growth. Or so some of these businesses, if you don't have the inside, the actual ownership skin in the game, then I'm always interested in if there's some sort of other compensation scheme that's interesting, or just what they focus on. There's in Sweden, there's a whole bunch of very successful serial acquirers, Lifco, AdTech, Lagercrantz, there's a whole bunch of them. And they all have this focus on capital allocation, return on capital employed. They all talk about it. They publish it in their reports. So, that I think that those tie into that ties into success, long-term success.
Could you even go another layer deeper there in terms of like family ownership and culture, right? Like all this stuff that's not very quantifiable when you unpack that a little bit more. I'm wondering, like, what specifically are you trying to tease out there?
Yeah. So this is something I've tried to spend more time on. So how do people say, it has good culture? Well, what does that mean? How can you test it? Is there something you can look at? And there are a few things I think are interesting to look at. One is employee turnover. So a lot of these businesses I mentioned, the employee turnover is very low. You look at Old Dominion, the turnover of their employees is the lowest in the industry by quite a bit. You look at Watsco, the top 30 executives have been there a long time. So they've got long tenured employees, long tenured management. There's this promotion from within culture. A lot of the people who are in senior management came up through the business. That's one way to kind of measure whether or not you really have that ownership culture. Brown & Brown, same way, employees own a bunch of stock. So there's people who have done very well, become very wealthy over time by being owners of the business. That's a key one. One that's maybe not as much, that's not talked about as much, but that's interesting is even to look at customer relationships and supplier relationships. Are they also very long-term? Sometimes you'll come across businesses where they may even report and say that their customers have been with them an average of X years. There was a book out a while ago. I forget the exact title, something about the Century Club, something about businesses that have been around 100 years. And one of the points that book brought up, which I thought was interesting, was the supplier relationship. So some of these businesses that have been around a long time, have used the same supplier for 30 years. And that also can be an indication of kind of a long-term relationship building culture. Happy customers. Do customers enjoy maybe is a strong word, but I mean, do they like what they're getting from the business? Yeah. Some of these are harder to gauge quantitatively as well, but there's something.
Yeah. Well, that's why you got to go deep. You got to do your own research there. One of the things you've done over the decades here is just a number of interviews with management teams. When you're sitting down with management teams, are there common themes you're trying to tease out there when you're interviewing them?
Yeah, I mean, I like to get their sense of the competitive landscape. What they think their advantages are, what they think their top competitors are, how they compare themselves, how they do it, what sort of metrics they focus on. That's always interesting, because one of the things I also like to do then is talk to former employees, or even competitors, and then see how those things match up, or if they do at all. I also like to focus a lot on the capital allocation. That's the important part. How do they think about reinvesting the profits that the business makes? And do they have some sense of return as being an important principle of that? So those are important things. Those are two big ones, I would say: competition, capital allocation.
I'm wondering how are you able to even kind of like see through the BS occasionally and just like really cut through that? Is there anything you've learned over the years?
Well, yeah, I mean, anytime you get the buzzwords, and I always, I don't like that. Don't want too much. You don't want a short-term focus either. If they're talking about quarters, then that's probably not a good thing. If they're not talking about ultimately the cash generation of the business, that's probably not a good thing. If they're overly focused on their stock, that can also be a red flag. Yeah, I think those are some of the main things.
Has there been a manager that you've probably spent more time studying than anyone else?
I don't know. Outside of somebody like Warren Buffett, I don't know. No one comes to mind. I mean, I've spent a lot of time on the names I own.
Yeah.
So like a Willis Johnson at Copart, he wrote a book, Junk to Gold, which is a good short read. Got an interesting story. There's not a whole lot on Mark Leonard Constellation, but he's worth studying. The Mendelsons at Heiko have done a really good job long term. Worth studying how they do business. Sometimes there's not as much out on these people, so I have great respect for Brown family, what they've done over time, but it's not like there's a whole lot out there to read. So those are some of the challenges you have.
Yeah. Well, I just appreciate what's coming through is just a true student of the game, true student of the craft, and finding some of these sources here. One of the things you were saying a few minutes ago, I'm pretty sure it was around incentives. You're like, that's something I've been trying to better understand. Same thing around culture. What else have you been trying to understand for over a decade now that you're still just like in hot pursuit of?
I'd love to find some way to kind of peek around a corner a little bit. And this is where I have a bias, where I like to invest in businesses that are showing good returns on capital today. Good returns on capital. They're already there, good reinvestment rates today, and then it's easier to kind of project forward. But I'd love to kind of be able to find or get better at, finding a company that's just kind of more a little earlier, and where their returns on capital are going to be very good over the next 5 or better than they have been. So being able to catch these little inflection points is really an art. And I would love to figure out ways to kind of peek ahead somehow and get little early indications that something has changed with the business.
Is there anything that you've come to find, let's call them around patterns around inflection points? And these could be positive inflection points or negatives. Is there anything that you've seen either through different quarterly reports or things like that can give you a preview that something may be happening, but whether it's positive or negative?
Well, negatives are easier. I mean, any kind of sizable acquisition that seems to be out of the norm was always a red flag, or any kind of significant step away from what has been their stated capital allocation policy, then it's a sudden change. That's always a red flag. We talked about incentives. Another red flag would be sort of an egregious compensation scheme. It's always a bad sign. I don't want to mention any particular stocks, but there's one where a CEO's pay has gone up like 10x in 3 years, and where they always seem to be taking an action that makes it more difficult for shareholders to be heard. So those are always red flags. On the positive side, that's one where I would like to work on a little more. I don't know. I mean, there's some obvious things like, you get a shift in return on incremental capital, which signals somehow there may be some kind of industry change, a large competitor, let's say a competitor starts to really struggle, or there's a wide gap between, one of the things I always like to look for is market share gain. So if you have a business that is just outperforming its peers by a large margin, Old Dominion Freight Line started, for example, we mentioned them before, trucking. I think it was maybe 10 years ago, their market share was like 2.5%, and it's 10% today. So, sustained level of taking market share, and they're still taking market share at around 1% or so a year. So I love those situations where you can find a business that has a small market share, it's gaining market share, and still their overall percentage is still pretty small. That can be an indication of a good long runway to go. So those are some things that come to mind, but those are things I'm always still looking to add clues to.
Yeah. No, what I appreciate so much is this adding clues, but also to kind of getting rid of some of the past thinking that doesn't work. And one of the things, I'm pretty sure you said this, if you're not cringing at the work you did 5 years ago, you're probably not getting better.
Yeah.
And so I'm wondering for you, just analyzing, let's call it like the last 5 to 10 years, are there certain things you had to get rid of, certain beliefs or ideas that just weren't serving you correctly?
Yeah. So, I think one of them is, I mentioned before, being overly influenced by kind of the multiple you pay now and not taking into account necessarily the return on capital and reinvestment rate and how that can really propel a stock going forward. So I remember looking at Copart way back in 2011. And I remember thinking it was kind of expensive then because it was trading at like 25 times earnings or something like that, let's say. But, the stock's up 10x since then, something like that. But if you go back and see what you could have paid for that business at that time, it's like 67 times earnings and still made 15% return annually over the next decade. So we had a 4-bagger. Yeah. So sometimes I think you can get maybe a little bit hung up on the multiple today, and you overlook the power of a high growth rate and high returns. So that's one example when I look back. Even though capital allocation is important, everybody knows 10 years ago, I would say I was much less critical of that. So I would have taken a dividend and or been okay with regular buybacks and not appreciated a business that was able to grow and reinvest all of its capital and grow organically as much. So, you get some of these businesses that they always just seem to be cheap and they just bump along and don't go anywhere. Part of it is that their capital allocation, they're not reinvesting it wisely. So I think earlier on too, I remember not paying nearly enough attention to competition as I do now. I remember, competitive advantages always sounded a little bit academic and people always want to talk about Michael Porter and blah, blah, blah. But it's really, really important because obviously you can't have a business compound. If you want to own a business for 10 years, you have to make sure you have a very strong competitive position. So I remember being much more lax about that. So I'd be involved in certain retailers and restaurant stocks that then, just didn't work out, even though the valuations were low and the business performed okay. The stocks didn't really work. So those are some things that stand out.
One of the things we were talking about at the beginning of this conversation, I would love to circle back to, is around what you're paying attention to. But I'm even thinking more specifically, multiple things that you're doing, right? Like you need to be taking in more information. You need to be able to distill it down, understand it. You also do a lot of your writing. You're on all these calls. How do you think about the format just of your day and what that looks like?
Yeah. Well, there's certain things I prefer reading. So anytime, transcripts or earnings calls, I definitely like to read those. Anytime management speaks anywhere, I'll read a transcript of that. I like these expert networks and some of the talking to competitors and things. Those can be a good source of little nuggets about how businesses work. So that's something I'm reading something like that almost every day as well. Obviously, you're much more busier around earnings season, going through different releases of not only the company you own, but like a competitor. So maybe if I own Copart, but I'll also see what IAA reports. Those would be kind of the higher quality things that I read. And then, I don't read as much investment letters as I used to. That's another thing. Perhaps we talked about things you have to get rid of. One is this idea that you're just going to kind of copy somebody else who seems to be successful. Cloning, I guess, can be successful, but ultimately I think you got to find things that you like and that you've done the work on and that you're comfortable holding, and not be so concerned about what others think, and appreciate that for every business there's going to be a bull and a bear case, and not be overly influenced by opinions of other people. So those are probably the top priority things. And it's different from what it was even, say, 10 years ago, for sure. I mean, I would have spent, if you would have asked me what my typical day would have been, I would have started by saying, oh, yeah, I read the Wall Street Journal, the Financial Times. And I don't read those things on a daily basis anymore at all. So the structure of my reading is totally different now. It's much more structured to that. If you were a long-term business owner, what would you be interested in versus necessarily trying to figure out what the next few quarters might be?
That's really helpful. Chris, I'm wondering if you were going to do this, right? Like be able to sit down with anyone, dead or alive, just ask away different questions of who would you love to do that with?
In the investing world, I mean, shoot, who wouldn't want to sit, especially with like Warren Buffett, say, even a little earlier, maybe not now, but let's say when he was younger, it would have been really interesting to talk to him. When he was more of an investor in stocks versus now he's, mostly owning businesses in their entirety. Or Charlie Munger early on would have been great to pick his brain, just sit there and talk with him. Those are the two I'd put at the top. I've had some great conversations with Chuck Ochray. He's a good source of wisdom for me. Those are the investing minds that come to work, business minds that come to mind.
Was that Chuck calling right now?
Yeah, I don't know who that
was. No, Chris, this has been fascinating for me. I love this. Like I mentioned, I've learned a lot from your writing over the years, how you see things that not only relate to investing, but also are applicable to the rest of your life. You've got a lot of interesting stuff, a lot of resources listeners can go to. Where would you want to direct them?
I mean, I think the best is you could go to my blog, which is on the Woodlock House Family Capital website. So I've written a bunch of stuff there. And I'm on Twitter. So sometimes I go through stretches where I don't post anything, but I'm a regular poster of stuff on Twitter. So my handle there is Chris W. Mayer, Mayer. Those are probably the two best places to follow what I'm up to.
Fantastic. Well, as always, all that'll be linked up in the show notes here in the transcript. But Chris, I can't thank you enough for joining us on What Got You There.
Hey, good to be on with you, Sean. Good questions. And it was a fun conversation. Thanks for having me.